it has a cult-like following, and stocks with a cult-like following can have valuations that are disconnected from reality. And our recommendation now is to be underweight the stock.
Hey, I'm Steven and this is Solving the Money Problem. If you're new, welcome. If you're not, welcome back. So in today's video, oh my god, I lost it. Try again. I'm just thinking about this guy in a few years' time. The internet never forgets. Oh boy. Alright, let's try that again. Okay, compose yourself, Steven. Right. Today we're hearing from an analyst who believes that Tesla stock is dramatically overvalued and completely disconnected from reality. He has a $180 price target on Tesla stock over the next 12 months, suggesting he believes the stock is going to fall about 70% from where it is today. So in this video, I'll share my thoughts and comments on the opinions of analyst Tony Sacconaghi of Bernstein. So let's get into the video. And by the way, since I know there's a lot of crypto lovers watching and people who like free stuff, it's your lucky day. For a limited time, you can get up to $250 in free crypto bonuses when funding a new account on BlockFi, where you can use cryptocurrency to earn interest, borrow cash, and buy or sell crypto. If you want your free crypto, use the link in the description. It also helps out the channel. And if you'd like up to 2 free stocks, check out the link in the description to WeBull. If you open a new account, you'll get 1 free stock valued up to $250 just for opening an account. And if you fund your account with $100, you'll get a second free stock valued up to $1,600. Unless you don't like free stocks, that is. And if you're in Australia, the UK, or New Zealand, you can get a free stock with stake, also using the link in the description. Let's get back to it.
Meantime, we're going to talk a little bit about Tesla right now because they made a statement with Plaid. That's the name of the company's new souped-up, more expensive Model S, which Elon Musk unveiled last night. And joining us right now to talk about what the Plaid does for Tesla's business in an increasingly competitive EV market is Tony Sacconaghi. He's the Bernstein Senior Research Analyst covering U.S. IT hardware. He has an underperform rating on Tesla and a $180 price target. He has an underperform rating on Tesla and a $180 price target, and a $180 price target.
I really feel bad for Tony. I mean, I honestly do. It's like seeing one of those members of a religious cult that thinks the world's ending. They go and sell all their possessions, try and warn all their friends and family the world's ending on this exact date at this exact time according to our prophecy. And then the day comes to pass and it turns out the world didn't end and they just didn't know what they were talking about. I mean, he's doing his best. Tony really is doing his best here, but the poor guy just cannot wrap his head around Tesla, the valuation, or what the company is, nor what their future looks like. And I feel bad for him. It's like, Tony, if you just had not started talking about Tesla stock, you would have been one of the top analysts out there. Unfortunately, you're a little bit outside your lane here, and it's just, I have to roast you, dude. This is not going to age very well. We've got Gordon Johnson here on one end of the analyst bell curve, down at $67 price target. We've got Alex Potter, I think, from Piper Sandler, up at $1,200 for a 12-month price target. Tony's not that far from Gordon the Genius Johnson with his price target. Does that not say everything you need to know? And Tony, maybe some friendly advice here. Just stop covering Tesla stock until further notice.
Tony, you have been a Tesla skeptic. Does the Plaid release change any of that for you?
No, it doesn't. But let me be clear that I've been a skeptic really about Tesla's valuation, not about the company itself. And I think, look, the Plaid was a welcome reassertion of Tesla's technology leadership in the EV space. I think the announcement last night was not really a surprise. They had released the specs in terms of the acceleration times and the new interior in advance. So this was really a marketing and coming out party and an announcement that Tesla's delivering the new Model S. But it's a tour de force, I think, from a technology perspective. My issue with Tesla over the last 8 months since we lowered our rating has really been about valuation.
This is a recurring theme I've noticed. It's almost like there's 3 independent, clearly defined groups of analysts covering Tesla stock. There's the bullish analysts who are bullish on the company, the technology, the leadership, etc., and also bullish on the stock. They see a huge amount of upside in the future. They understand the software component, the total addressable market, the install base, robo-taxis, the battery business, the solar business, the energy software business, and they see huge amounts of upside for Tesla stock in the future. Then there's another group of analysts who typically, from my experience, have been thrown Tesla stock to cover even though it's really outside their wheelhouse. They don't have the expertise or understanding to fully grasp what the company is. They're completely oblivious to the implications of artificial intelligence. They outsource their beliefs to other experts. For example, Tesla doesn't have LiDAR, therefore there's no way they're going to solve autonomy. Or they're an automotive analyst who looks at Tesla as if through the lens of an automotive company and completely neglects AI, completely neglects the battery business, completely neglects their engineering talent, completely neglects their leadership, completely neglects their engineering talent, their manufacturing expertise, all of the stuff that actually matters behind the scenes. They're completely oblivious to, and they just don't see it. They don't understand the implications of robotaxi. They don't see how far ahead Tesla is in terms of solving autonomy, and they just can't wrap their head around the company's valuation. Tony Sacconaghi is in that group. And then of course you've got the analyst whose opinion isn't even worth the time of day, the likes of Gordon the Genius Johnson, who clearly, in my opinion, doesn't believe what he says, has ulterior motives, nobody's that stupid, and occasionally there's a few analysts who actually just doubt that Tesla has any technology lead. They think that other automakers are going to come and eat their lunch, and these analysts are so dumb it's not even worth paying attention to their opinions. You'll note that Tony was very clear in saying that he's quite bullish on Tesla the company, he just doesn't get the valuation, the stock price. And in my opinion, it's not that Tesla stock is disconnected from reality, it's that Tony Sacconaghi can't actually fully see what the reality is.
But let me ask you, though, about valuation. Part of the valuation argument that you've been making is a long-term market share argument, which is to say that I think you believe that Volkswagen and so many other automakers are going to come up with electric products that really do compete meaningfully with Tesla. And we've been having that conversation for a very long time, and we haven't really reached that moment. When do you think that moment's going to happen?
Well, two things, Andrew. On the valuation side, it's not so much that Tesla's going to be undermined. It's really, even if you give Tesla the benefit of the doubt that they will become as large or larger than Volkswagen, sell more than 10 million cars, that's going to be at some point in the future. And you have to discount back those cash flows. So the fact that the stock is worth, 2 or 3x what car companies are today that are making 10 million units means it has to make a lot more than that in the future at much higher margins to justify the valuation.
So what Tony has said there is a fair statement. In order for Tesla stock to justify its current valuation, in the future, in the distant future, Tesla will need to be selling more than 10 million vehicles a year and will need higher margins than, say, a company like VW. But guess what, Tony? They will be doing both of those things. As we know, Tesla themselves are aiming for around 20 million vehicles per year, and I personally believe that Tesla is aiming for hardware margins just on the vehicles alone of around 40%. You can quote me on that. Now, I know that 40% margins on automotive sound absolutely insane, but hear me out here. Tesla has the world's best engineers, and we've seen demonstrations of this. We've had the Octavalve heat pump in the Model Y that's now in the Model 3 as well. Now we've seen the new Model S with an even crazier heat pump and thermal management system. We know about the gigacasting that's being implemented for the Model Y front, rear, and then in the future the battery pack as well. And here's the thing, Tesla continues to innovate and do more with less. They keep driving down the cost of manufacturing faster than any other automotive company has ever done, ever, as in ever. One more time, ever. Now, let me give you guys a bit of an example. It would make very little sense to use a huge gigacasting machine for, say, the Model S because let's say they sell around 50,000 units per year. The economies of scale aren't really there. It does make sense to use a gigacasting for, say, the Model Y, where the annual volumes will be 500,000 vehicles a year, then soon 1 million, maybe even 2 million vehicles per year. Guess what? Tesla's $25,000 vehicle due in 2023 is going to have even greater economies of scale. This thing is going to sell 5, 8, 10 million units per year. Tesla can invest even more in very expensive machinery and hardware because of the volumes of vehicles they'll be producing. They'll be able to do things that no other automotive manufacturer can do unless they're selling the same volumes of vehicles. Plus, no existing automaker today actually has the testicles to invest in this kind of equipment without knowing that the demand's there. And let's be honest, when you've got Tesla who have demand far in excess of their actual supply and big enough brain engineers and leadership to realize where the demand is in the future, Tesla, in my opinion, is the only company with the foresight and the kahunas to actually make these kind of investments to allow them to drive their costs down and increase their margins over time. But of course, we're only talking about the margins on the hardware at the moment. Tony seems to be completely oblivious to the fact that Tesla already has an install base of around 1.5 million users who can purchase today and in the future software, subscriptions, etc., which is almost pure margin revenue. Let me illustrate a very simple point here. Even Tony will be able to understand this one. Today, Tesla's full self-driving software package is a $10,000 upgrade. How does Tesla deploy this to a car? Do they need to spend any additional time, any engineers, any wages? No, they just press a fucking button over the air, suddenly your car has full self-driving. $10,000 pure profit out of thin air. Now, let's use a calculator and try to understand what this means for Tesla's margins. Let's just say, hypothetically speaking, you spend $10,000 on a software upgrade for Tesla's full self-driving package. Now, maybe you don't spend that money today, but maybe once Tesla has actually released full autonomy and you no longer need to actually pay attention behind the wheel, a lot of people opt for this, others will go for the subscription, but just bear with me here, I'm trying to illustrate a point. So say you spend $10,000 on this pure margin, pure profit software upgrade, in addition to having purchased your vehicle for, say, $50,000. Wow, you've just suddenly made an extra 20% margin on your vehicle out of thin air, over the air, instantaneously, without any additional expense on your part. Even if Tesla had piddly small margins on the actual hardware, when you factor in software, you can suddenly see how Tesla can have an extremely profitable, very high margin business. Oh, and that's just the start. Add that on top of the margins of automotive. Oh yeah, and then we've got Tesla Insurance. Add that as well. Remember, Tesla has the best telemetry. They'll be able to offer the best insurance. Practically everyone in 10 years' time who owns a Tesla will be using the Tesla insurance product. It just makes economic sense. That's even more margin. Oh, and then we've got the robo-taxis as well. Did I mention that? Yeah, exactly. Oh wait, you also forgot about the energy software and the home solar business, and I could actually keep going on. The point is, Tesla's margins are going to be ridiculous in 10 years' time. And the volume of automotive they're actually selling, easily 10, 15, 20 million vehicles in a decade's time. So Tony's right in what he says. Tesla will need to be selling a shitload of vehicles and they'll need to have very high margins. But Tesla has a roadmap to do exactly that. Unfortunately, Tony just doesn't seem to be able to infer this. I didn't even get to mention Dojo as a service and training of neural networks. Shout out to Amazon Web Services, which is the main margin driver, the profit center of their business today.
So that's the issue. But, Tesla has 20+% market share in electric vehicles today. Invariably, that will go down. It may go down to 10%, which will mean it will sell 10 million cars in the future. That could certainly happen, but the car industry globally is a highly fragmented market. There are local preferences, there are different needs in different countries. So, sustaining 20% market share of the overall car market ultimately when it becomes electric, I think will be very difficult.
I completely agree with Tony here. It will be very difficult for Tesla to maintain around a 20% share of the global automotive market. But maybe Tony isn't aware. You guys, maybe you can let him know. Difficult is what Elon Musk eats for breakfast, lunch, and dinner. Shout out to reusable rockets. Shout out to starting an electric vehicle company and not going bankrupt. I could keep going on. I think you guys get the point. This is just such one-dimensional thinking. It's like you ignore all of the available evidence. You ignore Tesla's lead, their leadership, their execution, their track record, the technological advantages, their manufacturing advantages. You ignore everything and go, well, it's going to be very difficult to do that. Yes, it is. But look at all the pieces of the puzzle. It seems all but inevitable that Tesla's going to be able to maintain this kind of share. The only major obstacle, the only thing that I personally believe could really stop Tesla maintaining this type of a market share is if they're limited in their ability to get battery cells. However, of all the companies on planet Earth who are likely to be limited in their ability to get battery cells, is it likely to be the company that's using more of them than anyone else at this point in time? It's already developed their own battery cells, that's got huge long-term contracts with suppliers all over the world for the raw materials they need? Or is it more likely to be the companies that fucked around and didn't realize they need a lot of battery cells and are now scrambling to try to get their own supply organized? Just asking the question.
So it's inevitable that Tesla will lose share, but that should be expected.
Tony, shorting Tesla has been thus far a fool's errand if you look at that chart. How should investors play? Would you actually suggest that somebody short the stock based on your expectation of what the stock is worth?
I think it's a very difficult stock to short. Most of the institutional clients that Bernstein serves are long-only investors. And now that Tesla's in the S&P, you have to make a decision. Are you going to be underweight, overweight, or market weight that stock? And our recommendation now is to be underweight the stock.
You heard it here first, ladies and gentlemen. Tony Sacconaghi here in mid-June 2021 with Tesla stock under $610 per share. Tony Sacconaghi and Bernstein recommending investors be underweight Tesla stock. It's not going to age well.
And so that's how I think about it. The stock is very news sensitive, very sensitive to Elon Musk's tweets. I think if you were, there's a borrow associated with it. So, shorting it is not for the faint at heart. For professional investors who want to pair trade it and think about it longer term, I think they can short it because, again, it's not the company per se, it's the valuation. And we've seen this in several segments of the market.
Is this a meme stock? Should we have this on the meme list?
It's not it has a cult-like following. Whether we would call it a meme stock, I think there's no, the short interest isn't as big. The stock can't be bullied around in the same way because of its market capitalization that meme stocks can. But it has a cult-like following, and stocks with a cult-like following can have valuations that are disconnected from reality. Now, we'll see in the long term whether that's the case or not.
I've got to give a little bit of credit to Tony here. It's good to see there's some humility there. He's not saying we're definitely going to be right. We're absolutely certain about this. He's saying, we'll see. We'll see if the stock is disconnected from reality. Well, now for a complete and utter lack of humility, I'm going to tell you guys for a fact that Tony's going to be dramatically, embarrassingly, catastrophically wrong. Tesla stock isn't disconnected from reality. Tony and Bernstein just can't see reality. And in fact, I'd love you guys to keep both myself and Tony accountable. Please set a reminder for 1 year, 2 years, 5 years, and 10 years from now to see where Tesla stock is versus $609 as I record this today. Tony would probably say, we'll see. This guy will say 10 years time, 2031, Tesla is a $6 trillion company. Mark my words. I literally mean that, by the way. Keep me accountable, set a reminder for exactly 10 years from now, see where Tesla's market cap is.
Our belief is the valuation today for a company selling 1 million cars a year, trading at multiples of companies that are selling 10 million cars a year today, seems disconnected.
Well, Tony, the bad news, in my completely unhumble opinion, you are dead fucking wrong. The good news is you're still relatively young and Tesla stock still has a very long way to go. So hopefully there'll be plenty of opportunity in the future to see the error of your ways and come around eventually. I'd love to know your thoughts in the comments below, guys. How many $1 trillion will Tesla's market cap be before Tony Sacconaghi finally sees the light and actually recommends people start buying Tesla stock? 1 trillion, 2 trillion, 3 trillion, 4 trillion? 5 trillion, 6 trillion, or will he never see the light? I'm Stephen Mark Ryan, this is Solving the Money Problem, and I love you all. And don't forget, if you'd like up to $250 in free crypto bonuses with BlockFi, use the link in the description. You can also get 2 free stocks with WeBull and a free stock with Stake, also linked in the description. Thanks so much for watching. Let me know your thoughts in the comments below. And of course, if you have any ideas for future videos, let me know. I read all your comments. P.S. If you're still watching, you're awesome. If you'd like early access, exclusive videos, regular Q&As, our private Discord server and more, consider supporting the channel at patreon.com/solvingthemoneyproblem so I can keep creating content for you guys. There's a link in the description. You can now also become a member of the channel for some exclusive perks. To learn more, click the join button next to subscribe. And don't forget to check out our merch store. Either way, the best form of support is you being here and watching, so thanks again.